Hey folks, welcome to Pro Trader Strategies. This is going to be cracking the code. We're trading options and we're going to crack the code for you here. But yeah, I am starting a little bit early. Sorry, that's probably the wife. We're going out to dinner. It's her birthday tonight, so I'm going to get this going a little bit earlier so we can go to dinner and celebrate. With that all said, please smash the like button before you go. Don't forget to hit the subscribe with the little bell. The bell is what tells you when I come in unannounced. If you're following us, subscribing, the bell will tell you when we pop in unannounced. All right. I do that a lot with my morning videos. Also, obviously it will happen with this video as well every once in a while. So with that said, we're going to be cracking the code to trading options here. And we are going to eventually, if I show my screen, eventually, we are going to be talking about the long call butterfly, folks. And this is a great strategy, especially with high volatility. And we're going to be talking about, we talk about volatility. And we talk about volatility in regards to the pricing. And usually when we're talking about pricing with volatility or pricing with the options, we don't want high volatility when we're getting long an option. So I always talk about the options here as, trying to make sure, I just broke my phone. Trying to make sure that when we're trading these options here, folks, that we're all on the same page. Like I said, the butterflies in general are a bit of a different beast here, all right? Think about it as they go from the caterpillar and they morph into something completely different. That's similar to what we're talking about with the butterfly. Believe it or not, long call butterfly, going to break a couple of rules. Yeah, we want high volatility for this one. I'm going to explain all of the levers and pulleys of this strategy here in a moment when we get into this. So without further ado, let's start talking about options. And folks, this is not options. This is actually data streaming. So when we're transferring data back and forth from computer to computer over the internet, this is how it's done. O's and ones, most simplest form of transferring data. So it's streamlined to a point that it is hyper speed. If you guys remember snail mail back in the day, it used to take a long time to get stuff through the internet. Well, this has helped streamline that process. And when we freeze frame it, strip back all of the layers here from this streaming data, we can easily see now that it's just O's and ones. Sometimes there's a couple of ones in a row. All right. So when we peel back this onion, it doesn't look nearly as intimidating. And that's what I'm going to be hoping to do for you folks today in this video on streamlining your process or really cracking the code to trading options. All right. What's the best investment somebody can have, right? If you're talking to an investment advisor, I might say some stocks, but for the most part, most widely thought of is the best investment is in dirt. I did say dirt. If you think about Rockefeller, that's what he would say. Back in the day, that guy said, I want to buy dirt because they aren't making any more of that. Very true. And we're seeing that with home prices, right? Home prices starting to rise. Why? Well, there is a limited amount of space here on this planet. So with that said, there is an increasing supply of people and this finite amount of land. So that's why most folks will say the best investment is in a house. But we have seen what housing prices have done lately, right? As a matter of fact, speculation as to what housing prices will do in the future. You know, they make it simple, like all you have to do when you're trading or buying a house, not trading. So actually, I think that some people should be trading houses right now, trading them in for an RV or something like that, or a fifth wheel, so that you can kind of scalp out of this house that you bought low, sell high, right? But housing prices, even if we just go only as far back as 2000, we saw markets moving higher. 2000, the dot-com, we did see a little bit of pullback in pricing for those houses. We shot up. 2008, we saw a pretty dramatic drop, 2008 to 2000, let's call it 11, before we started really recovering. Pandemic, we even saw a little bit, and that's almost where we saw the housing prices go parabolic. I mean, I was talking to some folks right before the pandemic, or right at the pandemic when it first started coming out, housing prices started taking a dip. I know somebody that sold or bought a house for, I think it was $600 thousand. I was going to throw a number out there, but it's 685, I think it was, something like that. And she sold it for over $1.5 million. So almost made $1 million throughout the pandemic buying a house up in the hills to get away. So while housing prices have shot up right now, we've gotten them parabolic, but we've also talked about rising interest rates. That could make housing prices really crater. So while folks will say that this is probably one of your best investments you can make, well, at the end of the day, you never know if you are buying high and selling low, right? You know, it's a simple concept pretty much. That's what most folks will talk to you about, but it's not really that simple to always just buy low. When you have the chart, look at it. Oh yeah, I can see where you sell high, right? That seems pretty simple. And that's really about as simple as they make it sound, especially on TV or anywhere else, even online with some folks doing blogs. It's not that easy. While it seems like a simple concept to buy low and sell high, we never really know, folks, if we are in fact buying low. Like, we don't know what is happening, for instance, from this part of the chart on, right? Maybe we were in here buying, but at the end of the day, you could think, okay, well, I could buy here, be pretty good. Whoops, buy, get that rally. Well, do you sell here? No, because you had this kind of idea, dreams of grandeur going on, and then the market sells off, right? I don't know if that's buying low or selling high, or if that's just buying high and selling low at this point. But what we do know is it isn't as simple a concept as just saying what you need to do is buy low and sell high. Why? Because we don't know what prices mean, right? I don't know what the value necessarily of these glasses are. It's different here in my house. Nobody wants these glasses. But I go out on the street, there could be 1,000 people looking for that type of glasses. Same thing with this pen. You know, if I lost this pen, I'd pay a lot of money for it to get it back because I can't use my computer without it. All right. Or at least my Wacom. But to somebody else like you might just think that that is a useless pen and there's no reason to have that in your house. It doesn't work on your phone. It doesn't work anywhere else except for on a Wacom, right? So while it's more valuable to me than it is to you, it still doesn't tell us where the prices are. Now, when we're trading, a lot of times what we'll do, based on the fact that we don't really know what the price of a stock or the value of a stock is, right? We can speculate. We let the professionals usually give us a pretty good idea that will tell us, hey, you know, the forward multiples on this stock based on their current earnings. All right, let's get this straight. We're basing this day's price today off of 10 years down the road and taking their earnings today and increasing them, you know, a multiple that we're just pulling out of a hat to find the price. Well, that doesn't make sense either. So, you know, stocks are very difficult. Now, while most people have a tendency to be able to see sideways trending markets a little bit better, and I talk a lot about this in the spotting the trade videos, and a lot of you folks out there are probably better chartists than me and spot things very quickly. It's a little bit more difficult to spot like support and resistances on bullish or bearish moves for the most part. It takes more of a trained eye usually to kind of draw those lines in there. But when we turn it sideways, it just seems a little bit easier. I mean, to that point, I was even talking about a head and shoulders pattern today in the spotting the trade videos, but it was inverted. Those head and shoulders patterns, when they're inverted, look a little bit different, like a W almost more so than head and shoulders, but they're still there. Those head and shoulders upside down take a little bit more of a trained eye though. But with that said, when we start trading and we trade around ranges, we can start to see where the stock, whether it's X, Y, Z, ABC, or whatever it is, starts losing that momentum to the upside when we put in those ranges. So sideways markets, like I always say, are a little bit easier to trade. I mean, IBM is one of my favorites all time of a sideways trending market that you can really, if you're getting into trading, that's a pretty good underline to start trading as far as I'm concerned. Why? Because it doesn't go parabolic like a Tesla or a stock that is correlated to maybe something like cryptocurrency or something that's beholden to that, like NVIDIA, right? So IBM, pretty slow burner to the side, but we can definitely draw in some nice support and resistance on a sideways trending market to capture that. So that will help us determine value in a sense when we're charting and using these support and resistances. But you guys, and I know, we just don't know if that price is actually accurate for the valuation of the company, right? We're seeing that happen right now across the board in the markets, where the markets are pricing in lower multiples on these stocks. That's what's causing the market to sell off, is because the forward multiples aren't as frothy, if you will. All right. So that's why the market is coming back. And you're going to start hearing folks, now that we've had a nice correction of close to 20% here, that this is an opportunity to buy. Now, I'm not saying that's not true. I don't know that the bottom is out yet either. I actually think we might get a little bit more of a dip, create a full-on head and shoulders pattern in some of these markets before we start resuming. So that's what I'm keeping an eye on. So when we're looking at charts, back to that, like I said, a little bit easier. We can pull up an IBM chart probably. Let's just do it. Since I'm talking so much about it, this is not IBM, obviously. IBM is this one here, but this had gone back. I've been trading IBM, folks, since college, and to date myself, that was in the 90s. All right. So IBM used to trade around 100, go up maybe 110, 115, drop down to around 90. Now it's a little bit higher here, but we could go back and look at this chart. I'll just throw this into a 3-year week chart or something like that. And we'll see that, look, it really hasn't gone anywhere other than pre-pandemic. We got a real nice spike. Post-pandemic, we got a real nice fall off. All right. But within that, I can go back in time and we are pretty much in that range back 20 years almost. All right. So IBM, a good one to trade sideways. Sorry, I got a little sidetracked there. But while it seems like it's a novel idea to buy low, sell high, what I'm trying to get at, folks, there's only one way to determine if price is expensive or cheap, especially in the equities world or even in the trading world. And that's because options will give us a little bit of a tell as to when they are cheap or when they're expensive. Now, it doesn't tell us what the price of the stock is doing, but it will tell us whether those options we are trading are expensive or cheap. And you guys know that that's what is the determining factor as the option strategy I'm going to choose. Volatility is really high. We need to take advantage of that high premiums over in the options. And when volatility is super cheap, we need to take advantage of buying opportunities. All right. So I did step a little bit fast there, but volatility is driving price, and volatility looks like this. It's moving sideways. We talked about with chartists going sideways. Volatility, pretty easy to find support and resistances on a sideways trending market. And while volatility breaks out of the range every once in a while, you know, like this one here, that is something I'm willing to accept. I want to try and clip or get the meat in between my lines. Yes, I am going to let it break out a few times here and there because I don't want the extremes necessarily. I want the norms. And I can take a little bit of heat as, you know, I've been trading for a long time, so I'm used to or have probably a little bit higher tolerance for risk. So, you know, while I go a little bit tighter, and I will eventually start showing you guys where I put in my lines to give you a gauge, I'll tell you where I think maybe newer traders should go a little bit wider for these types of barriers. Because what we're trying here is to find out whether options are expensive or cheap, because there's a rule with options. It's all about an advancement, okay? So that's the first thing you need to know. When you're looking at options, all of those numbers are telling you the assumption is on an advancement, whether that's a day with Theta, whether that's a dollar with Delta, or whether that is volatility with Vega. All right. And volatility, when I'm talking about volatility and you hear me say Vega, it's all the same. Implied volatility is Vega. All right. And we'll talk about that in a minute. But over in the options montage, Vega is talking about percent increases, and everything is based on an advancement of 1. All right. So if we were looking at this as implied volatility, let's just say it's 0 and it moves higher, let's say to 25 as just a number, then we would know that 25 and 0 are basically kind of, this would be a 5 maybe on a implied volatility percent number, right? So that getting very close is something I would be interested in. I like to look for, when it comes down and touches, that's the time where my radar goes up. All right. That's when the lights start flashing. You need to start paying attention. Now, if you're a newer trader, I would wait for this to break out of those ranges. And once it enters back in, that is where you would look to be buying your option strategy for whatever directional move you were looking for. All right. So that's the idea there. Same thing here. Maybe not take that trade, come up, wait for the re-entry area or a rebound off of it if you have a lower tolerance for risk. All right. So this is a real life example. And sorry, folks, I usually try to explain this all as I build from simple concepts to real life examples there. So while with this one, it isn't as clean as maybe that simple concept, we could still probably see a pretty good line in the sand that we could draw right along that dotted line if it were straight, and then kind of draw another line just right in there. Not very straight, but you guys, can you work with me a little bit on the bendy lines? And we know that when it's up here, these are extreme levels. What does that mean? That options are expensive. And then when it's down here, options are cheap, right? Way down here, we know options are expensive or cheap. And up here, we're talking expensive, like the most expensive we've seen, right? For the most part. So why do I know that? Or why do I even say that about the pricing over in the options? Because it's mathematical, folks. It doesn't matter where the underlying is, okay? So wipe that out. Notice that even over here, I don't even have a stock showing because I don't want you to get stuck on what the stock is versus the implied volatility right now. I just want you to notice that implied volatility for these underlyings, and this is a very long chart. This is like a couple of years here in the chart, at least, or 1 year. Sorry, this is a 1 year chart. But with that said, we can see that it stays within that range. I could draw this out to like a 3-year chart, and you folks will still see that it's probably still within. You could draw better lines on your chart and stretch them out in the past and see where those go. They will be pretty close because each individual underlying, each individual stock, ETF, future has its own implied volatility. Now, when I'm talking about volatility and implied volatility, I am not talking about the VIX, all right? We're not talking about the VIX or the VIXX. That is not what we're talking about. The VIX is a gauge of volatility, but it's a broader gauge of volatility. Basically, it's all the stocks. So when we see volatility or the VIX rise, it's all of the stocks. All right, it's saying that the majority or the average is rising dramatically. But there's still other stocks out there that have low volatility. It's trying to bring down that statistical average, but it's not necessarily doing it. So while some stocks might be sensing or feeling high volatility, there's still other stocks out there that are not, is what I'm trying to get at, because then we can focus on XYZ, ABC, whatever the stock is, implied volatility, which is this number over here. We look at their implied volatility to determine if those options are expensive or cheap then. Makes it pretty easy. As volatility is coming out, what does that tell you about the options prices. I'm not saying the underlying is moving. We haven't even gone a day into the future. So nothing's happened. All that's coming out is volatility. So when we're talking about that rule of one, implied volatility, right? As it downticks 1 percentage point, and remember, this is not in a percentage point format, it's in a decimal point, right? So move the 2 decimal places and you've got 30, so 30%. If it drops down to 29, 28, premiums are coming out. Even if the underlying's not moving, we start to see those prices come off, all right? So that would then indicate that you want to sell when it is high and buy when it's low. Now, I've got a couple of lines here for you guys to think about. I usually go right in the middle, 50-50. Above is a sell, below is a buy. Now, if you're newer to trading options, you're just learning, then I would suggest throwing another line in there and then say that only when it goes below or above that line, basically in the highest quarter or the lowest quarter of the range, that's where you start implementing your strategy on buying or selling options, okay? And that's not a bad one to have. You're going to have less opportunities there, but then the times that it's trading within those like quarter hash marks, right? We talked about the split there. When it's up here in this area, then right in the middle, we have other strategies that we can counteract some of that volatility. We've already talked about a couple of them in previous videos, and I'm going to talk about a few more coming up. But there are strategies that we can isolate some of the negative effects that the options are doing to our pricing. And then we can go out to another underlying. This one thing I want to note with the other one, the previous underlying, they're pretty close though, but we can see that the extreme high is above 40, extreme low. This one, extreme high goes up to about 45, extreme low comes down to around 25. So every underlying, the last one was XYZ, so we'll say that that this one is ABC, right? So every underlying, every different stock has its own volatility coefficient or implied volatility range. Tesla never gets down to 30 or 40. Almost never. I haven't checked it in a day or two, but it almost never gets down to those levels. It's usually up into 50s, 60s. All right. So while one might want to say, hey, well, implied volatility over in Tesla is a lot more than ABC, I should be selling Tesla options. No, don't think of it that way, because Tesla's options are based on Tesla's implied volatility. All right. An implied volatility range for Tesla is much different paradigm than the implied volatility for Apple or something else. Let's say a utility, or IBM even for that matter. So if we look back to this last one, we would see we were trading right around 34. Some folks might say, hey, you know what? That range can't possibly go on for a long duration. Sorry. But then I stretch it out for a few years here. And you can see if I threw in a 3-year chart, I think this is of Apple actually, but if I throw this in on a 3-year chart, you can see those are the same lines drawn back even before the pandemic. That's kind of where we were. Yeah, maybe a little shift higher, right? Just an incremental click higher. We've gone from here to kind of like that, which is not bizarre, is it? I mean, since the pandemic, wouldn't you expect that we are a slightly higher volatility across the board? I mean, we know the VIX is a lot higher now. I mean, it's in the 20s, 30s, right? On any given day, where average for the VIX is usually in the teens, right? At least historically. So we can see that while we are an incremental higher, that range has still been pretty much intact for this underlying. So I encourage you folks, when you're looking at these trades and you're looking at implied volatility, check it out, stretch it out, look back in time. Implied volatility is great because it's forward looking. It's not going to adjust itself based on the data points, all right, because it's forward looking. It's just going to keep that data point there. Historical volatility has a little bit of wankiness sometimes. You can use it though, all right? I just wouldn't use it like very long term. I would not take that data points into effect as much because historical volatility is a ranking current volatility based on where historical volatility has been. I've just told you the volatility for these underlyings doesn't move outside the range too far. So you can get away with historical volatility if you don't have implied volatility on your charting system. So I think that implied volatility is better because it's forward looking based on future expectations of volatility. I'm a forward looking guy. Historical volatility tells us where we are now in relation to where we've been in the past, kind of. All right, a little bit of a different scenario, but you know, if push comes to shove, I would use the historical, and I don't really have a problem with people using the historical versus implied. That was a big battle on the floor as to whether somebody used historical volatility or implied volatility. That was always a fun argument folks would have at the bar or whatever. Here is one that I'm looking at with a little bit tighter range that I was talking about, right? I would go a little bit tighter, have those break out a little bit every now and again. I would not worry about taking a couple of percentage points heat on selling an option. It goes up a little bit. I'm not going to worry too much about that. Yes, I know I didn't sell the high, but when do you ever get to sell the high? When do you ever get to buy the low? Almost never. Unless you like catching falling knives or arrows. But me, I'm going to go a little bit tighter there. For you folks, I would say kind of try and draw a line in a little bit higher and clip a few less of them. Maybe I would probably have to go in somewhere like that, a little bit lower there. But, you know, you guys get my drift. Go a little bit further out from a more aggressive trading strategy there, or straight trading regimen, I guess. A little bit further out, newer traders, where I'd kind of try and draw that line out there. But again, our 50-50 is going to be basically very close. Your sell zone might be just above mine, and your buy zone just below mine, right? So that would work out nicely. You're going to have less opportunities, but you're also going to take less heat on these trades, meaning I can sell high, volatility goes higher. I know that because I'm up there, it may only go 5 percentage points against me. So I'm not too worried about that pricing hurting me too much. Yeah, I'm a little, you know, I'm going to have it in the back of my head, but I know that it's probably not going to blow out on me too much. You know, because, you know, the one thing is because the volatility, I don't really see us getting another pandemic in the next year or so. So we call that a black swan event. So volatility absolutely drives pricing. As a matter of fact, I think it's the main driver. I call it the main driver of pricing. Yes, if you go further out in time, pricing out there is really expensive. I'm not going to lie. You go a couple of days to expiration, that pricing is super cheap. So what do? Well, if you want to be in this trade for a long time, you have to pay for that opportunity. That's why those options way out in time are more expensive. But volatility at any given moment can go up or down. Just what the stock can too. But we understand how if the stock goes up in prices, calls go up in price, right? I'll talk about that maybe a little bit more if you're unfamiliar. Throw questions over in the chat window, guys. I'm checking over there. That's why I keep flicking my head. I'm looking for some questions. So I'll answer those to make sure you're clear concept before we go on. So when volatility increases, despite the fact that the underlying might be going down, like in an instance like this, the underlying's been going down, but when you had that volatility increasing, well, that volatility increasing could be offsetting a negative move. Like say, for instance, you bought calls and volatility started increasing on this negative move there, that volatility increasing into the earnings you could actually see yourself doing okay, offsetting all of the gains. Because while delta fluctuates prices based on the fluctuation of the underlying, volatility at any given moment, even in a sideways trending market like this, we could see volatility, or even a downward trending market, volatility starting to increase, right? It can increase on the rally as well. So while volatility is fluctuating, the underlying might not move a penny. Those prices in the options are moving higher and lower based on every one incremental tick. Sorry, the light's messing it up. Every one tick down, those prices are going down over in the option montage, even if this underlying is just trading sideways. Volatility starts going higher, those prices are getting higher in the options, even if this is still 103. Okay, 103. Still, we're trading 103. We can't get out of that range, right? Volatility is going higher. Those options are getting more expensive, all right? And I'll show you how that works out here in a second. So just a little bit of review. I want to talk about something, try and make this a simple concept, if we will. But, you know, when we go over, like I said, over in that option montage page, it kind of looks like that data streaming, right? Well, let's try and freeze frame this, peel back the onion, and take a look. So when we're talking about, everybody wants to talk about delta, right? Because that's one of the most simple concepts. Delta, that's the symbol for change, okay? So the delta, and that's what we used to say on the floor. What's the delta? The delta at the money are the options that are trading. If let's just say an example of ABC here, if it's going to let me, I'm just going to go here. ABC. This is our stock. All right, let's just say it's trading at $100 even. Right, make math easy. So delta at the monies with the options, at the money options are the ones that are trading at the money of the stock. So the at the money options for ABC are what? 100. Pretty easy, right? That's at the money. That's as close to where the underlying is trading as you can get. That's what most folks will say at the money stocks are. Some folks will even stretch it out and say the 95 to the 105s are at the money, because at any given moment, those could be right there. That's fine. We're splitting hairs. At the money are the ones that are the closest to the stocks trading. So those stocks, those at the money stocks, all right, at the money, let's say 100 calls over here, and the 100 puts could over there. Calls are always positive, and let's say the 100 puts, those are always negative delta. And if we're talking about the at the monies, these are going to be a 0.50, and these would be a 0.50 negative. All right, because remember, we were just talking about this. The assumption with the options are an advancement. All right, moving higher, moving forward. We don't go backwards, is what they're saying. And so that's why some of these will have some negatives as well. But at the monies are a 50 delta. So delta tells us that if the underlying increases by $1, right? We said it's an increment of 1, increases by $1. These at the money options, let's say they're $2.50 at $3. Okay. That's the bid offer for the calls. Let's just say it's the same for the puts, $2.50 at $3. Okay. So when the underlying moves higher by $1, it tells us that the delta goes in. So we get that 50 cents going in here. So that underlying, we've gone ABC now equal to 101. What happens to the delta? Delta goes in there. Now we're $3 at $3.50. That's just on $1 increment higher. Now the puts, notice that it is a negative number. That negative on $1 higher, now we go to $2 to $2.50, right? Because an increase, our puts have a negative delta. So on that increase, they go negative. Now, if you go down by $1, guys, it's a negative. It goes back to basic math, right? A negative plus a positive delta, a negative move plus a positive delta is a negative to our position. So the underlying goes down by $1, that delta becomes a negative, right? Just think it doesn't show up as a negative, but you have to think we're moving down. Negative plus a positive is a negative, right? Vice versa, if I sold, or the underlying starts going down, I should say, the market starts selling off is what I wanted to say, then our puts, a negative dollar move plus a negative delta means what? Positive, right? So if we started moving down, the puts would start increasing in value. Now, the next option we have, or the next Greek, we have is gamma. All right. And gamma, you just have to remember, goes with delta. All right. On dollar number 2. All right. It's on the second dollar. So when ABC then goes to equal 102, the gamma goes into the delta. So gamma is usually pretty small. Let's just say it's 10 cents. It's going to probably be less than that, but for argument's sake, gamma goes into delta on the second dollar. So now we've got 10 cents plus the 50 cents, 60 cents goes into the calls on the next dollar. So we go to 360 at 410. All right. And it'll do the same over on the put side. But remember, gamma is going to be a positive. So the next dollar move higher, gamma goes into delta. Delta is negative, gamma is positive. So a positive plus a negative makes that go to like a 40 delta, right? In that sense. Everybody with me so far? Don't forget to smash that like button. If you're with me, I'm following, I'm making this easy. Help me out, smash that like button because that shares it with somebody else that might want this information. All right, now I'm getting a little broken up here. The next one, though, is, what's the next Greek? Well, it's my name for the next Greek. Thief. That's Theta. Theta is the thief in the night that comes and steals your premium. Easy way to remember. Delta is just data. I forgot to say that. Delta, we on the floor used to say, is just data. Gamma goes with delta, all right? Theta is the thief. Just keep that one in mind. And he always is stealing money from you, all right? It doesn't matter if you bought it or sold it, right? He's still stealing money from you. The closer we get to expiration, like the nearer and nearer to these options going off the board, like less days left in them, Theta gets really aggressive because he knows he only has a couple more days to steal the rest of your money. Is the way you got to look at it. So it's not linear, all right? It's not a dollar, a penny, okay? It's basically a penny, a nickel, a dime, a quarter, dollars, and then, big money. So what we look at, it really falling off of a cliff, is basically 7 days to expiration. That's really where you get that massive acceleration in theta decay. But most traders are a little bit longer duration than 1 or 2 days. At least that's what I find anymore. You might even call yourself a swing trader, but you're probably willing to go several days with a trade. And then we see right here at around 35 days to expiration and that's where it starts rolling. That's where you start getting up to speed, all right? That's where theta starts really getting into a groove. I would say, though, 45 days to expiration, a little bit further out there, is kind of like what I look for going this way as your sell zone, all right? Why is this a sell zone? Well, look at it. Sell high. You get the thief helping you out if you were to sell those options. Theta is constantly eroding and really starting to get aggressive. So you want that on your side. You want that bully in your pocket, right? And then you go basically out to here and you can see that it will start to slowly flatten out. It never gets flat. It's always a slight ramp, if you will, even though I made a drawing that doesn't look like that. But this is kind of your buy zone. I like to get into the buy here because it doesn't really increase that much. And I'm usually only in trades maybe 30 days or something. So that's kind of the wheelhouse I like to look for when I'm buying. Yeah, you can go further out. You'll limit theta, but you're paying a lot. You're tying up a lot more money is what I would say. You're not really paying a lot, I wouldn't say, because you're being a good steward of your capital. If you pay more and it doesn't erode, well, then that seems to make sense in my eyes, rather than paying a little bit less, but all of a sudden, percentage wise, that's just getting gobbled up. I'd rather go out, pay a little bit more, know I'm being a good steward of my capital, and buy with the slower slope of theta, right? Or the thief. And then we look at Vega. It's the other option over there. But remember, I said all you got to know is it's a fancy name for implied volatility. We can find implied volatility in a lot of different places in the options platforms. Vega only really shows up over there in the options montage, probably because they didn't have a line long enough to put implied volatility in there. And so they made up a Greek to be a part of the Greeks, and that's Vega. And we talked about that. That is based on a 1 percentage point move increase, right? Starts decreasing. Vega is positive. So when we see volatility increase, we also see an increase across, or when volatility increase, I should say, when we see volatility increase, all of the options increase in lockstep with their corresponding Vega coefficient, all right? And we'll talk about that, what that number is here in a minute. But then when volatility goes down, all of the premiums, calls and puts, go down in value as well. So we don't have to worry about the Greeks when we go over to the option montage now. So here we get over to the option montage. Freeze framed it again, trying to just peel back this onion for you folks. We can see that when we go over here to the call side, right there, call side, put side, right? We've got our delta, which is just data. You can see these at the monies, which are the closest to the 200s where we're trading. Yeah, one could split hairs and say the 75s are. The 75s, the 197.5s are closer, but I'm going to call it off on the 200s. Those are the ones we got as closest to 50. So what do we say? Delta tells us that when the underlying increases by $1 and we go to 198.44, right? Exactly $1, then delta will go into these premiums over here. All right. So 49 cents will go into that 835. So we'll basically be looking at 884 bid at $9.04 or something. I know I did that wrong. $9.14. So it'll go in on that first dollar move. Gamma, what do we say? Goes with delta on dollar number 2. So then we would be up to 199.44, right? And now that 2 cents goes in there and becomes 51 cents that then goes over into those corresponding premiums, okay? Flip side, delta, gamma, we moved a dollar higher. This is a negative delta. That first 51 cents would come out of that 1075. Then on the next dollar move, gamma goes with delta. What happens there? First dollar move, it went up by 51 cents. Next dollar is 49 cents coming out of the premiums. Okay. Makes sense so far? And then we can go over and take a look at the Theta, the thief that comes and steals your premiums. Theta, we can see right here, is definitely a bigger number than way out here. That's how much he's taking every single night. But we can see 108 days out. Basically, what's that, 30 days to come in? What happened to the Theta coefficient? It increased. It increased by a whole 3 cents, right? Maybe, yeah, we could call it 3 cents. So not a whole lot of erosion over that time. We go, takes 45 days. In the next 45 days, we got an increase of 2 cents there. So that's why I'm like, you know what? You don't really need to be out here and doing this buy area way out there, yeah, you limited theta decay, but look, it did not, if you would have gotten in this area for the next 30 days, it didn't dramatically increase. So that's that slow slope area that we were talking about in my previous chart, right? You can see that this increased just about as much. So incrementally, it seems linear there, right? But then we go from basically 45 days in the next 30 days. What happens? We got another 13 cents in there, right? It almost doubled in that next 35 days. So when you're selling options, you want to be in this area. I can't tell you how many times I see folks on TV and even on blogs like this talking about buying options in those front months with even high volatility. Like, you're going to get crushed in that type of scenario. High volatility you're buying, we know that if volatility comes out, even if you're directionally right, you could still lose money. Why? Because the underlying has to, if volatility started coming out of Netflix, right? We know that if Vega goes down by 1 percentage point, that all of the premiums associated to Vega start going down, right? So we could see a situation where, let's just for instance say volatility, Vega goes down by 3 percentage points and XYZ goes up to 198.44, exactly $1. What happens to our trade? Doesn't matter where you're looking, to be honest. If let's just take a gander at the calls, really. So the call side over here in the options, let's just go to the nearer duration ones. We've got a dollar move higher. So our premiums increased over here by that 49 cents. So we talked about this. This then goes to 84 on the bid. And then on the offer, we went to 914. You know, check me if I'm wrong on my math. I'm trying to do this in my head while still thinking about other things. All right. But now we also have this going on the other side. 3 percentage point decrease in volatility, right? So now we're at 60.07, right? So 3 percentage points decrease on this dollar. This is a dollar move higher, right? So moved higher by $1, premiums increased, or, you know, thinking they increased to that. But in the meantime, we have 17 cents in Vega. What's 17 times 3? 51, right? 17 or 0.17 times 3. If my math is still working, that tells me it's 51 cents, right? So if volatility goes down, it's a negative plus a positive makes that number negative. So now we just decreased by 51 cents. So that means that those prices, although we were directionally right, say you bought calls, right? You bought calls and the next second it increased by $1. Vega dropped by 3 cents. You're thinking you're a genius. What happened? You're going to be looking at your downtick happening. Actually, that's probably 33, and this is 863, right? You lost 2 cents. Anybody having a light bulb moment on that? That's why it's imperative, folks. Imperative, you know when you should be buying or where you should be buying. You should not be buying options way up here. Okay? That's the sell zone for those reasons. All right? And if we start adding in the theta component to that trade tomorrow, then you can see where you would really be hurting. All right? So let's take a look at this trade for Netflix. I meant to have my Netflix chart up there based on Netflix not doing anything. That's why I had this Netflix up here. And feel free, like I said, folks, if you're new right now, throw questions over there. And you know, like on Facebook, I don't know that I get to see the Facebook questions. Or on If you're watching this delayed, I will circle back around and make sure everybody's clear of concept. Now, while the 3-year chart has the point of control, which is where the most time and volume has been spent, the volume has been spent down here at around this area. So I don't know if we're ready to cover this gap right now. I don't think Netflix is through the headwinds that they've been seeing with, look, people aren't afraid to go to the movie theaters. We just saw that with the newest release of, what was it, Top Gun. People are going back. So when we get to points of controls, like around these areas, some people say they're support and resistances. I say they're friggin' magnet, guys. It draws there. Think about it. Anytime you make a trade and it goes back to your price, are you really interested in buying or selling it right there? You kind of see volumes settle down around those levels because we've all traded it. We don't really want to get that price again. All right. So I think it's going to settle down here. So we were talking about a trade to take advantage of high implied volatility, which we can see Netflix has a high implied volatility. As a matter of fact, when we're talking about implied volatility ranges, look, the low in Netflix is probably 24. The high is 80. So pretty good range there on that one. High volatility, though, it's above that 50 mark that I was talking about. So I'm thinking I want to collect a credit at least, right? Not right now. I'll tell you why. Because we're going to be doing the butterfly, folks. And I'm going to show you why this trade sets up as a long call butterfly versus what we want to happen. All right. This is where you got to put your thinking caps on. All right. Because we're going to be talking about pricing pretty seriously. All right. Over here, how we build out a butterfly, a long call butterfly. Let's first look at the long call, right? We're looking at buying the 175 calls, which I would never suggest in a million years to do this trade alone. This long call. I don't do in the money long call spreads anyway. So don't get confused with this. This is just about building out a strategy. Going from the 175s to the at the monies. Why? Because the at the monies are the ones that I want to be selling in my butterfly. So when we're building this out, I'm always looking at the at the monies to sell and the monies for this strategy are the buy. So the reason why it is considered a long call butterfly is because of this long call. This long call is a big old debit, all right, that we probably are not going to get away from. And the reason why it's a debit is because we're buying those in the money options, all right? And we're selling these two that are at the money, okay? That creates the long call spread of creating the long call butterfly. Then we would want to sell an option strategy at the same strike, those 200 calls, we're going to sell those, and then we're going to buy an out of the money option, all right? That gives us a credit. The previous strategy gave us a big old huge debit, right? $15 debit. Then with the short call spread that we're smashing into it, we get an $8.50 credit, right? So ultimately, when you put that all together, we can take the credit analyze tab, right? And then we slap in what the long call spread is, right? So let's go back to this. This is the short call spread, analyze tab. Short call spread, you want the market to go down, right? It's a bearish strategy. If it goes down, I make this money, right? If it goes up, I lose. But on the flip side, then I'm going to slap in a bullish strategy, which is the long call spread, right? So long call spread moves higher, I make money. Moves lower, I lose money. But when you squeeze those two together, you get this big triangle, right? Got the call spreads together, tops out right here. So what we're saying is if the underlying finishes at the end of the trading cycle, right there, that's where we make the most money. And that is right there at the 200 strike, okay? If it goes lower, we have a max loss there of the debit we pay. So while most of the rules are thrown out the door for what I consider to trade, what you need in order to trade. This one's a little bit different, although only in the fact that we're saying it's a long call and we want to take advantage of the short calls. All right. So let's go back to this real quick. So the long call spread. I don't know why that has the negative, why I have a short there, but I didn't mean to do that, other than I was trying to, I believe, sorry. And now I know where I was at, the 200 calls. So what I like to do is first go to the 200 or the at the money options. And those at the money options right there on the calls are $13.60. So like I said, that's where I like to go and sell my 2 calls. So start out there. I look at the pricing. I actually know it's probably right in between there, $13.50. All right. But I've sold 2 of them. All right. $13 is my credit. Well, what does that mean when I sold 2 of them? Well, that means my credit is actually $26 because there's 2 of them there, right? One is $13 I collected. Second one I collected another $13. It's about $26, right? So double the credit is how far you go away for your defined risk. So in this case, 13 is 26, right? 2 times that. Well, $25 is about as close as I can get. So I'm going to go for that one to define the risk, and the 25s on the upside to define that risk. Okay. Which we bring this in, and that's how we do it. All right. So $7.23. That's the $13 or what was it? $15 debit from the long call spread, and that $7-ish plus dollar credit from the short call spread, right? But I want to go back to this because this is what really throws this strategy a little bit, right? Because we're buying that option that is so deep in the money, right? We pay a lot for it. Now, in a lot of the other videos, I haven't talked about this a whole lot. So for some of you guys that have stuck through this start to finish, you get something new here. What we're talking about here is at the money options. We were talking about them being a 50 delta, all that stuff, right? Those are the ones that are close to where the underlying's trading. Well, at the money options basically have no value, especially these 200s, right? Because it's trading 197. These at the monies are actually slightly out of the money. And if they're out of the money, there is no real value to owning that underlying. You're basically buying the opportunity, okay, to be right. But there is that theta component, that thief in the night, that's going to try and steal all of the extrinsic value of an option, which is basically all the time value of that option. Remember, further out in time, you pay more for that option. The closer and closer, it's dwindling, right? And that theta has got to get all of that extrinsic value out before it closes. So out of the money options, which are calls above the market or puts below the market, have no intrinsic value. It's all extrinsic value, all theta, all right? So theta is what decays away. Extrinsic value is what theta really represents. It does represent volatility and everything else, but we know that all of that extrinsic value, those options that are out of the money, will be worthless at expiration because there's no probability of being in the money after expiration, right? These options that are in the money, probably should change my color. Let's try and see if I can get this changed over real quick. The options that are in the money, which are the ones that are in the green, are the ones that have intrinsic value. All right. So intrinsic value of an option, let's say that these calls over here, these 165 calls, right, draw the line across, are $37 right in there, right? Now, an in the money option has intrinsic and extrinsic value. The intrinsic value is the value of the option, meaning what its benefit is, of owning that stock, right? So if I buy the 165 calls that are in the money, and this underlying is trading 197, the difference from 165 to 197 is what that option is worth, right? I'll say that again. The 165 calls that are in the money are only worth their intrinsic value. Their benefit is only worth that amount from 165 to 197, which is basically $32. But what do we see over here? I know my is $32, and these prices are 37, so almost $5, right? Well, a little floor trader hack for you folks that have been sticking around for this one. If you look over to the puts, that gives you a great hint of what the extrinsic value of the in the money options are. All right. So what we said, this is 32. It's about $4 or $5. Well, look over here. It's right around $4 or $5. So you don't have to burn all that brain power. Yeah, you're not going to get it down to the gnats, but you are going to be able to get it very close enough for government working to trade. So that's what I would go with. So when we do this strategy, remember, we're buying one of these, the 175s, we're buying 175. Well, that is in the money, and we know that its value is close to 23. Still, like $6 in extrinsic value we can see. And then we sell two of these options that are at the money. So those are the ones that really create this strategy. Remember, I wanted high volatility to get really pumped up premiums. Well, these at the monies are going to have the most, all right? So that said, if I sell two of those and that's all extrinsic value, that means those go to zero. So I've collected a total of $26 for selling those two options. I paid 39 for the other, 30 for the other ones, right? What was it? Close to 30, 25 for the other ones, sorry. So I'm collecting 26 here, sold one that is at the 175s for right around $30. All right. Just helping with my collection to find the risk out here at the 225s, paying a little bit more of a debit. That's how we end up making our way back to that debit we paid. But if the underlying, we want it to stay right here, right? I said this is a neutral strategy. We want the underlying to stay right there at that 200 level. If that happens, these options are worthless at expiration. This option, if we stayed right here, stayed right around 200, right? These options we know are worth 25. Why? They're worth 25 because that's the intrinsic value of a 175 option. From 175 to 200 is $25. So we know that that option, that 175 option at the expiration of this option contract, those 175 calls, if the underlying is trading 200, are worth 25 because I am paid at least the benefit, if not a little bit more. And then these ones that we bought are going to be worthless. So we're going to lose money there. We're going to lose $6 here, right? Because those are the extrinsic value of these options, right? We're going to lose $6 there. We're going to lose $5 here, but we're going to make $26 in and around there. All right. So by selling those options, the options we sell decay worthless. That's how this strategy is made. Those long calls in the money, yeah, they will retain a lot of their value because they're in the money options and they have a benefit. There's a benefit to owning a call below the market, right? It gives me the opportunity to buy something lower than where it's currently traded. So there's a benefit to having in the money options. Same for if you buy a put above the market, it gives you the opportunity to sell, right? So obviously they have a benefit to being in the money. But then when we simply layer it together, we can see that we get the paradigm where if the underlying settles right there, we're just slightly lower than that. We get that 200 settlement. Really, you want it to settle 199.99, 1 penny out of the money. So both those options expire worthless. That would be the perfect case scenario. So you don't have to deal with, the options assignment risk. So if we can get that very close, that's what I'm going to be looking for. As a matter of fact, with this strategy, the risk reward is really good. If you're building it out the way that I've described, you should be able to get into a situation where, folks, you are risking 1 to make 2, or very close to that. You can see here, I'm risking what? $723, whereas my top here is over 15. So I'm easily risking 1 to make 2, right? It is a relatively low probability strategy, right? Because we know we have to nail this right in this little range. But with volatility coming out, that will help us as well. It's more going, but it's still going to take time to get through. You're going to need Theta on your side. So you want to get closer to expiration, get him on your side, because really the way that this strategy makes the money is if all those options that we sold expire for 0, right? That will offset all the other Theta decay, the in the money options, the 175, those will be worth $25, right? Those are worth $25. We settle at 200. Well, it's the width of that spread. So it's perfect, right? So that's what we want to have happen. This long call spread, we're getting long. We're selling a short call spread to kind of offset some of those prices that we'd have to put up for it. All right. All right. Does anybody else have any other questions before we? No? Pretty simple though. Theta decay is going to be a huge helper here. I know it's a little confusing. Long call butterfly, you want high volatility. Just remember, the butterflies morph the rules, if you will, right? It's counterintuitive. Long call, yeah, we do need to sell those at the monies. The reason why it's considered a long call butterfly is because of those in the money options creating a debit. But don't mistake it for needing low volatility. If you have low volatility, your wings are going to come in, and actually you'll probably be able to set it up for the same rules, risk 1 to make 2. But the lines are going to look more like this. All right. On your chart, they should be even there though, but it'll come in a little bit. All right. Because remember, higher premiums are going to push it out. That's what we want. We want to get involved when it's pushed out and then let it come in a little. That'll help. Okay. Anybody else have questions? All right. I'm going to throw you guys a link for an offer that we're using here today. We're going to be doing this options course here, over 15 hours of content. Rising interest rates. Anybody worried about rising interest rates right now? I'm hearing like 50 coming in on the next 3 meetings to get us at above 2% possibly. What's that going to do to the economy? I don't know, but I know what it's going to do to your portfolio just on those rising interest rates. I mean, unless you have 0 bonds in your portfolio, you don't have like a 401k or anything like that, then you don't have anything to worry about. But if you are concerned about 50% of your portfolio losing value, you should probably take a look at just this one video on how to protect your portfolio from rising interest rates. No, I'm not telling you to go out there and sell all your bonds. I'm going to even tell you why you shouldn't be selling your bonds and trying to go after the higher interest rate. Like, you'll even learn about that. We'll talk about the market profile and when, where, and why we would be looking to trade these options. Really streamlining your process. I want you folks to be able to look in the option montage, not get that sick feeling like, oh my God, what am I going to be doing? I want you to go in there with confidence. I want you to be able to go on Twitter and be like, dude, why are you buying calls in Apple when volatility is through the roof? You should be selling puts or something, or selling a put spread to take advantage of that high implied volatility, take advantage of the probabilities in your favor, and therefore turn the tables of luck your way. All right. And listen, folks, I don't believe in luck. I believe that luck comes about through opportunity. All right. If you put yourself out there and give yourself more opportunities, yeah, you're going to look really friggin' lucky because you're going to be knocking it out of the park all the time. And for $36, guys, interest rates move the next 2 meetings. I can guarantee you're going to probably be losing $36,000 out of your portfolio value from your bonds. I mean, I don't know what your value is, but check out this video, and it's a real eye opener for a lot of folks. All right, so take advantage of that. Like I said, I threw that link over there. This is what that link will take you to. This page here, you can see a little bit more color on what we are offering here. All of those different videos, you can check those off. I'm sorry, I don't know how to turn that phone off, but I'm just going to say thank you guys all. Please smash the like button before you go with the closing music. And don't forget to subscribe, hit the bell, because the bell, folks, will let you know when I'm coming in unannounced. That's all I got. Check out the Spotting the Trade videos every morning. If you can't take that, take it easy.